Is Citi stock a deep value investment? Interestingly, the stock surged last week 13% as their earnings beat estimates, beat expectations. And you see none other than the deep value Berkshire Hathaway, Warren Buffett's Berkshire Hathaway, buying around a $3 billion position in Citi, around 3% of the company. It's one of their top 20 positions now at Berkshire Hathaway, which is interesting to see. This was probably done by one of the lieutenants, not necessarily Warren Buffett himself. And then you also see that Citi stock really hasn't gone anywhere for 5 years, which makes me wonder, hey, if the fundamentals are there, could this be getting increasingly cheap? And as you look at the fundamentals, it's interesting to see that their earnings have been growing over time, $22 billion in earnings last year. And you see that they've done literally tens of billions of dollars worth of buybacks over time. And you also see that their tangible book value has been steadily increasing from $60 per share in tangible book value to nearly $80 per share. Now, you also look at effectively the leverage in the system, where it has around $190 billion in equity versus around $2.3 trillion in assets. So that means if their assets declined by about 8%, then the company would be broke. So it is really important that they have good quality assets. But it is fascinating to see after this latest earnings update that their tangible book value is around $80 a share. The stock price trades around $50. So think about tangible book value means this is the price that they think they could effectively liquidate the company for around this value. So usually you see companies trade at this value, maybe even a premium if you think the franchise is worth it, if you're going to get an attractive return on investment. So that's about 60% upside. If you were to spread that out, let's say over 5 years, annualize that 60% potential, gain that you could see, that could be, high single digit, around 9% a year. Now, this does get investors sort of saying, well, wait a second, isn't there this concern that their actual earnings did decline in the most recent quarter, seeing profit fall? Well, yeah, you did, but let's look actually at the relative health of this business, where you see their revenue was up 11% year over year to $19.6 billion versus the prior year period where it was $17.8 billion. And you see that their underlying operating expenses to run these various different segments was only increasing by around 8%. So yes, their core profitability increased, but really what happened is, so how come the decline in their pre-tax income and their underlying income, why did that decline by 20-30%? It's really a function of the cost of credit, so interest rates moving higher, but it's also saying, hey, last year at this time, we released reserves saying, hey, we don't need to have all these sort of accounting, reserves saying we don't expect to have a lot of bad losses in the future. So last year during this period, they released around $2.4 billion from their balance sheet saying, hey, this isn't actually stuff that we're expecting to have losses on, so we're good. It's really an accounting approach. And now they're saying, you know what, we got to start adding some of these back, around $375 million in expected, allowance for potential credit losses. This is a way of saying, hey, how secure, how solid is our balance sheet? What are we looking at here? And as I already mentioned, they do have leverage around 12 times leverage for a bank. Before the great financial crisis, a lot of these banks were closer to 20 to 30 times. So this is much healthier, I'd argue, but you do see sort of the capital cycle is changing from releases of, effectively allowances, releases, to now adding to their buffers to make sure you don't see problems. And you do see this with the data. You are starting to see, at least with their credit card portfolio, you are starting to see an ever so slight uptick in, let's say, non-performing loans or loans that are 90 days past due, where you see it just starting to tick up very slightly over the last 2 quarters. Still very low relative to where it was previously, where it was, over a few quarters ago, closer to the depths of the pandemic. Now you are just starting to see a slight uptick. Maybe that's due to, what you're seeing from the central banks, slowly tightening the system. Now, what we're looking at here, talking about their credit card portfolio, this is Citi's personal banking and wealth management segment. So their PBWM segment, which includes branded cards, retail services, retail banking, as well as wealth management. But they also have this institutional clients group, which has a bunch of other functionality: trade and, treasury and trade solutions, security services, equity markets and fixed income markets. So where they're trading bonds and stocks, as well as investment banking and corporate lending, so providing loans to businesses. And as you look at these two different segments, the reality is if you look at their institutional client group, that is the one that's generating the vast majority of their profits, hasn't really seen the downturn so far, very much more stable business than, let's say, the credit card receivable portfolio that you have, in their PBWM segment. So in the most recent quarter, $4 billion from their institutional client group, only $0.6 billion in net income from the PBWM segment. And so looking at this institutional client group, which is really fascinating. I mean, some of the metrics here just really blow my mind. I mean, look, they have trading floors across 80 different countries. The Citi is just such a massive company. So even though they have like a $1-2 trillion in assets on their balance sheet, the security services managed segment manages $23 trillion in assets under custody and administration as of March 31st, 2022. And so that is just mind-blowing to me that they effectively help oversee more assets than the U.S. economy. And this is just such a massive, business. Now, that's not on their balance sheet. That is separate from their balance sheet, but it just does reflect just what a massive influence they have with helping other institutions, businesses, governments manage their treasury, manage their cash and resources, which is just incredible. Now, how should you think about Citi stock going forward? First, if you're looking for compelling investment ideas or want to take charge of your investment journey, consider unrivaledinvesting.com. Looking at the valuation, once again, going back to the fact that their tangible book value per share over $80 per share as of the most recent quarter. So if the stock goes from around $50 to this $80 over the next 5 years, that's around 9% annualized, which is, quite interesting, especially given the fact that sometimes if sentiment changes where they say, hey, this business is actually worth more than liquidation value, then you could actually get a premium to that. And then you layer in the fact that management is still saying, yeah, but we still think this business is going to grow. We're still hoping that this business grows at a low teens rate. So this is really interesting. You layer in potential change in valuation of, let's say, 9%, like I was just talking about, that gets you to that, around that tangible book value. Layer in a return on tangible capital, or return on tangible equity of, let's say, around low teens. And, shareholders could potentially be looking at around 20% annualized returns over, let's say, the next 5 years, 100, 200% potential upside from here. So that is really interesting. Now, what is management seeing of this? Now, they do see the stock as being quite cheap. Regarding the macro, they're talking about saying, yeah, we don't see the U.S. is being on the cusp of a recession. That's not what the data is saying. Consumer spending remains well above pre-COVID levels, with household savings providing a cushion for future stress. They talk about the job market being really tight. And so saying, yeah, yes, a recession could take place over the next 2 years. No one has perfect clarity over the future. They view it still highly unlikely to be a sharper downturn as others in recent memory, thinking about the great financial crisis. However, Europe is a different story, talking about the energy supply crisis that they are facing. So this is really interesting. I mean, this does sort of create the risk that if they're managing it, let's say you see something like JP Morgan, where Jamie Dimon, the head of JP Morgan, is talking about like, oh, it's a hurricane, and he's talking about how do you prepare for that. Whereas with Citi, they're sort of saying, hey, we're not really worried about this at this point. So it does make me wonder if that means Citi could get hurt worse if ultimately there is a recession or if there is an economic downturn, because it sounds like based on their commentary, they're not crazy preparing for it. You are starting to slightly see it with their change in allowances, but maybe you get a little bit more whiplash with Citi for the fact that, hey, they're effectively saying, hey, we're not seeing a recession right now, at least based on their data. And as I already mentioned, that looking at their credit card portfolio, it's not like these performing loans or the non-performing loans are, dramatically surging. It's just barely an uptick so far. So I look at Citi stock, and it's really not surprising to see the deep value investors, at Berkshire Hathaway buying, around $3 billion worth of stock. Wouldn't surprise me to see them buy more in the most recent quarter because, look at it. It trades at a huge discount, like a 40% discount to around liquidation value. You layer in the fact that they're going to be compounding this business over time. So this setup with Citi certainly seems interesting. my concern, as always with banks, is it's not only about sort of what's your upside, but you also want to consider what's your potential blow up risk as well. And that comes down to the comment I made earlier is you have all these assets, in this case, around $2 trillion in assets for Citi, and then you have around $200 billion in equity. And so you say, well, if there's, let's say, a 10% decline in value for these assets, that wipes out your equity. So I'm going to do a further deeper analysis for my Unrivaled Investing subscribers, in a letter talking about, hey, here's, not only do you have this potential that I talk about with Citi, and I do like the potential, clearly the folks at Berkshire Hathaway like it as well, but in this letter, I want to think about and dive further into understanding, okay, so what are the blow up risks with Citi? What are the thoughts around what could drive that asset decline that could put equity value for shareholders, Citi's shareholders, at risk? Is that a risk to think about? Because that's something I need to, look into further, because clearly this is a very interesting setup. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.